If you're near retirement and an insurance agent or financial advisor has thrown around terms like fixed index annuity, fixed annuity, or lifetime income rider, shown you a bunch of charts and you nodded your head like you understood, but secretly didn't, this video is for you. In the next few minutes, I'm going to go over the three main types of fixed annuities in simple language, show you exactly what they're good for, and the big mistakes I see people make over and over again. By the end of this video, you will be able to look at an annuity illustration, know what to look for in that illustration, know what questions to ask about that illustration, and you'll know what to watch out for. Just a quick reminder or overview. Annuities, these are insurance contracts. They're not magic. They trade some flexibility and some upside in exchange for safety, guarantees, and sometimes lifetime income. This is not personal advice. Product details vary greatly by carrier or company and also by state. My goal in this video is to simply give you a mental map so you don't get lost in the jargon and you know what questions to ask and what to look for. In this video, we're going to cover multi-year guaranteed annuities, also known as MYGAs, fixed index growth annuities, fixed index income annuities. Then I'll cover the two big expensive mistakes that I see people make over and over again. Let's start with what's called a multi-year guaranteed annuity. And these are often referred to as MYGAs, M-Y-G-A, multi-year guaranteed annuity. You can think of a MYGA as a CD that is offered by an insurance company instead of a bank. You give the insurance company a lump sum of money. The insurance company guarantees a certain interest rate for a certain period of time, usually between 2 and 10 years. Your principal is protected by the insurance company, and growth is typically tax deferred until you take the money out, unless you have this inside of some sort of tax deferred retirement account like an IRA or a Roth IRA. Now the key points are that MYGAs, they generally have a bit higher rates than CDs do, and the terms offered or the contracts offered tend to be longer than what banks offer. And many of these contracts, they allow you to withdraw a certain percentage of the money every year without incurring any fees. If you do go higher than what they call free withdrawal, you will be charged with surrender charges, and you can think of these as early withdrawal fees. So the use case for a MYGA is you want predictable CD-like growth, you don't want stock market-like swings, and you're okay locking up your money for a set period of time. Now, let's talk about fixed index growth annuities. So a fixed index growth, key word is growth. A fixed index growth annuity is essentially principal protection plus upside or growth. Now, fixed index annuities, they tie your interest crediting to stock market indices like the S&P 500 or NASDAQ. You're not actually in the stock market, but your growth, your crediting is linked to what the stock market is doing. Your principal is protected from market losses. And when the stock market or your index goes up, you participate in that upside, but not all of that upside. When the market or your index goes down, you receive zero, not negative. Now, it's important to point out that these specific annuities, they are designed and optimized for growth. They are not, and I want to emphasize this, they are not optimized for guaranteed lifetime income. These types of annuities, they usually have a contract period between 5 and 10 years, and you are able to take out 10% a year without any penalty during that contract period. And most of these growth annuities, they don't have an obvious or overt fee that you have to pay every year. So what's the use case for these fixed index growth annuities? They're for people who want better growth or potential upside than, say, a MYGA or a CD, and people who hate losing money, while being okay with not getting every little bit of upside that the market has to offer. As I said before, there's a 5 to 10 year period, depending on the contract, where your money is locked up. And once that time period is over, you can take the lump sum out of the annuity, roll it into a new annuity, put it into some other type of investment, or in some cases you may just go and spend that money. Okay, so let's talk about fixed indexed income annuities. Now, with fixed indexed income annuities, the key word is income, because with this type of annuity, you're creating a lifetime paycheck, a paycheck that comes in no matter what. It's guaranteed by the insurance company. I also like to call it setting up your own private pension. It's the same idea. And it's with this type of annuity that people get really confused with. Now, these annuities have what are called income riders, and they're specifically designed to create a paycheck that you can't outlive. And again, I also like to use the analogy that these annuities are like setting up your own private pension. So with these annuities, there are 2 buckets that you need to be aware of. And this is incredibly important, so much so that I suggest that you take notes. The first bucket that I want to talk about is what we call either cash value or account value. And you'll see this on annuity illustrations, and it's really, again, really important to pay attention to this. This is the real money inside of the annuity. It does grow, but generally at a slower rate than the growth annuities that we just talked about. In addition, any fees that you pay for that income rider, usually about 1 to 1.5%, those fees come from your account value, the real money. And in a second, I'll talk to you about the income base. So what is this income base or benefit base? Income or benefit base, really important to understand. This number is not real money, and you cannot withdraw money from the income base. It is what we in the industry call funny money. It is simply the number to calculate your income when you finally turn on that income. Now, the income base or the benefit base may have a very big bonus, things like 20, 25% bonus. But remember, this is not real money. This is your income base or your benefit base. And the income base or benefit base, it may grow at a roll-up rate until you start your income. What that means is the longer you wait for that roll-up to happen and increase this benefit base, the bigger the lifetime paycheck that you will receive. Now, annuity salespeople, they will play kind of smoke and mirrors games with this income benefit base because of the bonuses and the roll-up rate and all this sort of thing. It's really important. The only question that matters here, what is the dollar amount that they guarantee to actually pay you for life when they turn on that lifetime guaranteed paycheck? So who are these income annuities for? Is for those who want a guaranteed paycheck, a paycheck that they can't outlive, and for those who are willing to pay an annual fee to receive that paycheck. And you need to be willing to trade that security in exchange for not getting as much growth and not having as much flexibility. This is for people who want a paycheck that they can't outlive, and they're okay paying a fee for that insurance. Okay, so let's talk about the two most common expensive mistakes that people make. The first mistake is using an income annuity like a growth annuity. And so what happens here is that someone buys an income annuity, maybe they're drawn in by the big bonus and the roll-up rate, and they totally misunderstand, and they end up taking big withdrawals from the account value before they start that lifetime paycheck, that lifetime income. Meanwhile, they don't realize at the same time that 1 to 1.5% fee that comes out every year, that's coming out of that account value that they're making big withdrawals from. That in turn means that the account value shrinks faster than they realize. And that then causes a lower lifetime paycheck when they finally turn on that lifetime income. If your main goal is growth and flexibility, you usually want a growth-focused tool, not an income-focused product that has annual fees such that you can receive that lifetime guaranteed income. So the second mistake, this one is huge, and I ask you to be very, very careful about this. And this mistake is simply confusing the account value or the cash value with the income base or the benefit base. And what happens is an annuity salesperson, advisor, or insurance guy, they show you an illustration and they focus on this income base or benefit base. And they tend not to focus on the account value or the cash value. And why they focus there is because they will oftentimes give a very large bonus to the income base. Again, this is to the income base or the benefit base. This is funny money. They will also talk about the roll-up rate. And this is usually a very high interest rate that is added every year to the income base or the benefit base, not the actual cash inside the annuity that you can withdraw. Now this looks amazing on paper and it's a very shiny, attractive object, but you usually cannot walk away with that income base number. You can't make a big lump sum withdrawal on your income base. You can't borrow against your income base, and your heirs, when you die, typically do not get your income base either. The income base or benefit base is simply the number that is used to calculate what your lifetime income will be when you decide to take that lifetime income. So instead of focusing on the income base or the benefit base, the question you need to ask and the answer you need to focus on is how much money, if I start income age 65, 70, or 75, how much money will this annuity guarantee to pay me every year until I die? So let's recap. A multi-year guaranteed annuity, also known as a MYGA, is very similar to a CD. It receives a fixed interest rate and tax deferred. In fact, on the point of tax deferral, all of the annuities that we talked about today, they are also tax deferred. Now, a fixed index growth annuity is principal protected with market-linked upside, usually doesn't have any fees as part of the annuity unless you add riders, and it's generally good for safer growth. Now, a fixed index income annuity is built for lifetime income, and the income base is used only to calculate your income. It is not spendable cash. And if there is a wrong match between the product and the goal, that is where the pain happens. Now, if you're near retirement or in retirement and you'd like to learn more how annuities along with other assets, fit into your overall retirement plan, I'd be happy to walk you through it. Below this video, there's a link such that you can go directly to my calendar, and we can take a look at your situation, what you own, and so forth, and walk through some scenarios such that you can ask questions, learn more, and make an informed decision as to what's best for you. Now, this video is for educational purposes only. It is not financial advice, it's not legal advice, nor tax advice. Any guarantees mentioned as it relates to annuities, those guarantees are based on the claims paying ability of the insurance carrier. Please always talk to a licensed professional such as myself before making any financial decisions. Thanks for watching, and if you like the content and would like to receive more, press the like button, subscribe, and share it with someone who you think may benefit from this information. Confusion around annuities is more common than you think.